Hey guys, have you noticed that the vibe in the US stock market has been feeling off lately? By all logic. The Fed gearing up to cut interest rates should be huge news, right? I mean, for decades, every time rates dropped, it kicked off a stock market party. But weirdly, this time Wall Street is nervous. Big players aren't celebrating. Instead, it's like they're already digging bunkers ahead of a storm. Why? Because this time rate cuts might not save the US economy. JP Morgan put it bluntly, stop dreaming rate cuts could backfire, and Goldman Sachs, even harsher, they're outright saying even if the Fed cuts multiple times, the US economy might not bounce back until 2026. And the real kicker, the Bureau of Labor, statistics quietly revised last year's job numbers down by 910,000. Seriously, 910,000 jobs. What does that even mean? This isn't some margin of error. This is a massive hole blown right through the job market. And all that talk about strong employment we've been hearing from Trump, that turns out it was just statistical fluff. It's like someone bragging about their gym gains only to find out at the checkout that their muscles are fake, just full of air. And have you noticed how weirdly things are playing out? Trump just fired the head of the Bureau of Labor Statistics a few days ago, accusing him of manipulating data. Then the revised data comes out and proves the market is even weaker than we thought. Is this a statistical method, adjustment, or political blame shifting? No one knows for sure, but one thing is clear. The fundamentals of the US economy are riskier than we realized. And that's exactly what I want to break down today. I'm going to unpack JP Morgan's 3 big reasons why rate cuts could backfire. Break down Goldman's gloomy prediction that the economy won't recover till 2026. And explain why this jobs data revision might be the final blow to market confidence. In this video, let's start with rate cuts don't work anymore and connect all these seemingly separate clues. By the end, you'll see that this time the Fed might not save the economy, it might actually push us into an early winter. So if everyone thinks rate cuts are a lifesaver, why is JP Morgan throwing cold water on that idea? They say cuts could not only be useless, but make things worse. They gave 3 reasons: lower retirement income, reduced willingness to borrow, and lasting uncertainty. Sounds mild at first, but when you look closer, each reason is scarier than the last. First reason, retirement income takes a hit. Rate cuts mean lower interest rates, which means lower returns on treasury bonds and savings. Who gets hurt the most? Retirees. Imagine an elderly person living off bond interest. They used to get $1,000 a month, but after a rate cut, it drops to $800. Suddenly, medicine, rent, and daily expenses become tight. They won't leverage or take out loans like young people. They'll tighten their belts. Don't underestimate this groups. Pension spending makes up over 7% of GDP. Once this part of consumption shrinks, the whole economy's resilience takes a hit.